Okay, so welcome back to Communication Performance, where we correct contracts written by attorneys, right? And in this college video series, as I mentioned, we're going to prove, and I believe we've already done that in the first four videos. This is, I believe, the sixth video in this series, right? But in the previous four videos, or the previous five videos, I believe that we've done that. So let's jump right into it. As I said, that we're going to review um, what a promissory note is and what a certificate of deposit is. A certificate of deposit is your receipt. It's your proof that the bank received a sum of money or funds when you gave them or when you turned over your promissory note. So it is no difference than when you go to the bank and you give the bank um, $500, right, to store for you, right, because that's what they're doing. Or rather, let's be more correct. When you give the bank or the bank accepts $500 or purchase $500 because those Federal Reserve notes are promissory notes, right? So they're no different than the note that you give them when you purchase a car. That is also a promissory note, right? And it is made legal tender just like the promissory note by law, right? And so you can have a promissory note, and then you can have a promissory note that's made legal tender by law, and they're distinct, right? Even though both of them are promissory note, but if you have a promissory note made legal tender, it is authorized by law, which it puts it in a higher class than just a regular promissory note, right? But once the bank accept your promissory note, right, or your security, right, then the bank owes you a sum of money or funds. And the way that you evidence that is for you to get a certificate of deposit, right? Which is a bank note. So let's get into it. See if we can do a quick review before we jump back into the video. So, so let's take a look at, so let's define what a promissory note is first. Okay. So here we have a promissory note. Make it a little bit bigger. Okay, so here we have a promissory note. Uh, Batteries used to be charged. Okay, so here we have a promissory note. Okay, so Okay, so here we have the definition of a promissory note. Now, this is, as I've stated, this is based off of Maryland statutes, commercial law, but the technical name is the State of Maryland Uniform Commercial Code, which is close, or it's it's compatible generally with all the other states' uniform commercial code or commercial law. So if you see 9-102, generally you should be able to get the same section 9-102 for secure transaction, Title 9 secure transaction in your state generally. But whatever information, all the states basically have the same information. So it may be a section um, above or lower, or uh, but they have similar numbers. So you shouldn't have any problems finding this uh, particular section in your state's uniform commercial code or commercial law. So we're going to go to Division 66, where the definition of a promissory note is defined. Okay. Okay, so let's go ahead and take a look at this. So it says promissory note, right? So it says means an instrument that evidence a promise to pay a monetary obligation, right? So we promise to pay a monetary obligation, right? And you should pay special attention to this particular word right there. That is a future tense word, right? So to pay, promise to pay a monetary obligation, right? But once the bank purchase the note, right, the bank receives a deposit of a sum of money or funds. So let's do this. Let's read it clear, or read it all the way through, and then what we're gonna do, we're gonna make some edits to this definition. So it says promissory note means an instrument that evidences a promise to pay a monetary obligation, does not evidence an order to pay, and does not contain an acknowledgement by a bank that the bank has received for deposit a sum of money or funds. Okay, so let's go through it. So promissory note means an instrument. It is an instrument, and that's defined in 3-104 of the commercial law that defines what an instrument is, a negotiable instrument, right? So when it says it's an instrument, you can say it's a negotiable instrument, right? That evidence a promise to pay. It evidenced the promise to pay. So once the bank buys that note, that is your payment that you're giving them, right? Because you have an innate right to create credit, and that note is evidence not only of your promise to pay, but also of your credit, which the bank transfers into their electronic spreadsheets. So when they say banks create money, is they don't create money. You create the money from your autonomous right to create credit. The bank simply just records it in the electronic spreadsheets or um, their decentralized spreadsheets that they refer to as a blockchain, right? So doing data entry is not creating anything. You're recording the value in your spreadsheet, right? It is a bookkeeping entry, right? But you're switching, or I'm sorry, you're making an exchange for your promissory note. They increase their asset, but then they have a reciprocal duty based off of the contract of the exchange because they purchase um, your loan contract, which is the promissory note. They have a reciprocal duty to pay you for that because they made a purchase, right? So every credit by a bank must first have an initial extension of credit from the issuer of that monetary instrument, which is legal tender, right? That note that you give them and you sign, that is legal tender. Now, the problem that we run into is that we sign that note in blank, which is you just sign your note. I mean, sorry, you just sign your name and you just date it, right? That is what's called a blank endorsement. And blank endorsement, basically, you're just giving free money away. That allows the bank or whoever gets it, probably the car dealer, to sell it. And then, but the problem is you gave the bank payment, you don't know it because you signed it in blank, but you know, the biggest problem is, or the problem is not that you sign it in blank, is that you don't have no evidence that you gave them money or legal tender or value and consideration with that note, with that security. So that's why you have to get a certificate of deposit as evidence that you gave them value and consideration. You gave them credit, right? Because all money, when it boils down, all money is credit. I don't care. You're talking about gold is credit because your credit and your ability to make contract create the value, right? Based off of your purchasing power, right? It is you value is created by contract, on this case an exchange, right? So yeah, so you when you sign that in blank, you basically are just you just gave the money away, like no difference than you just gave somebody $500, right? You don't even know them, you just gave them $500 and you have no evidence that you gave them $500. So they can, with a uh, a promissory note with a blank endorsement, they can sell that, right? Anybody, if anybody finds it, they can sell it. So you need to give a special endorsement when um, endorse the notes, right? Pay to the order of whoever you're paying to the order of. And then you can, well, we're not going to get into it, but uh, I don't want to, I don't want to be repetitive, but you can do an accord and satisfaction. And well, you could do a couple other things, but accord and satisfaction based off of your state law. and you can look that up in law. You also reserve your rights, right? So you don't surrender any rights. Whatever the contract says, it doesn't matter because you're going to reserve your rights, right? So the contract may have you as the borrower, but since you are the issuer of the note, you are reserving your rights. So that will nullify that, right? Because that is your term. And remember, it's a contract. So you have the right to negotiate and and implement your terms to the contract. And once the banks accepts it, it also accepts your terms. So that is very important that you sign promissory notes um, with a special endorsement, right? Paid to the order of, and then you also make them understand that this is a full payment, write it across the face of the note, paid in full or full payment, any, you know, full paid in full, right? That's what I would do. Paid in full. Um, you do your uh, special endorsement. You do an accord and satisfaction, letting them know that this is full payment and accord and satisfaction is in your state law, and you should be able to include that code, right, with um, your endorsement, and also reserve your rights. And uh, uh, reservation of rights is also in your state code, so you should definitely get those two codes: reservation of rights and also accord and satisfaction, which is full payment of the debt obligation, right? Which is your promise to pay them, right? So remember, when it comes to property, right, you're selling your property, which is the note, right, for the thing, right? And so you are, once you sell it, then the bank has control, right? This is why you don't, banks don't, well, one of the reasons why we cannot say that you give a bank a deposit. The bank owes you a deposit because the bank is making a purchase of your payment instrument, which is that note, right? And once they accept it, you have made a payment, but you don't know you've made a payment. And the other thing is you have no evidence that you've made the payment. So we're going to go over what the evidence is for you making a payment with your note, right? Because the entire banking system is based off of a promise to pay, which is a promissory note, but it may come in different forms. They may say it's a draft, a bill of exchange, etc. But they may say it's a bond, but it's basically a promise. All of them are promises to pay, right? So let's get back to the definition of promissory note. So promissory note is an instrument that evidences a promise to pay a monetary obligation, right? So you paid your monetary obligation when the banks accepts your note. That's why their asset increase on the asset side of their balance sheet, their cash increase, right? Now it says it does not evidence an order to pay. The reason why it doesn't evidence an order to pay is because it's not a draft, right? So that is just extra language that's just there to confuse you. And then it also says, and does not contain an acknowledgement by the bank that the bank has received for deposit a sum of money or funds. So this is also extra language here, or part of it, when it says does not contain an acknowledgement by a bank. Your promissory note is not going to contain an acknowledgement by the bank because you are issuing that. The bank is not issuing the note to you. You are issuing the note to the bank. So that's why their acknowledgement is not going to be in there. So that's just language to fool you, right? To trick you, get you confused, right? To confuse you. So if we eliminate the extra language, then we can read it clearly, and it'll now we know we're able to read it and find out what the definition of promissory note really is, right? And you can look up promissory note is defined as a security in um, the federal securities law, Security Act of 1933, and the Security Exchange Act of 1934. It's also in your state code define a note as security. And it's also in your state code that your note can also be collateral, right? Um, so, so let's read this definition of a promissory note in a clear, concise language, right? When we eliminate the the extra language that's meant to confuse you, right? So it says promissory note means an instrument that evidences a promise to pay a monetary obligation, and the bank has received for deposit a sum of money or funds. So when you pay the monetary obligation, right, your promise to pay the bank, then with your note, the bank receives a deposit, right? I'm sorry. The bank receive a sum of money or funds, which is your deposit, right? The bank don't receive a deposit. That's also there to trick you, right? Because the bank doesn't receive a deposit. So we could get rid of this too, right? That's also extra language because the deposit is defined in law as the debt the bank owes the general creditor, which is the issuer of the note or the seller of the note, which is you. So let's read it again. The promissory note means an instrument that evidences a promise to pay a monetary obligation, and the bank has received a sum of money or funds, right? And because it receives a sum of money or funds, then it owes you a deposit. It receives a sum of money or funds under the asset side of its balance sheet, and then it owes you a deposit under the liability side um, of the balance sheet, right? So it receives a sum of money or funds as an asset, but then it owes you um, a deposit, right? And this is the liability, right? So you have the asset side, and then you have the liability side um, of of the bank's balance sheet. But again, you should also have a balance sheet, right? That you use as uh, your ledger for your accounting, whether it's electronic or paper journal, right? You do your bookkeeping and your accounting just as you would for business because that is your proof, right? If you don't get a certificate of deposit, then that is your proof that you have against their balance sheet. You know, you can get rid of any type of controversy if you get a certificate of deposit once you give them your note. Now, that is a decision that you have to make, and you may just want to make payments, right? But what we do at Communication Performance, specifically when it comes to banking, our main focus is to prove that the instrument that the bank purchased from the seller, which is you, they may refer to you as a customer, right? That is value and consideration that the bank is getting. So then, based on double entry bookkeeping, they owe you a deposit because the bank made a purchase. It's no difference than if they went out here and purchased a pair of tennis shoes, right? They make a purchase, then they got to pay the debt, right? But in this case, they make a purchase or credit. So, and it's the same thing if you're talking about a credit card. You're still giving the bank a promise to pay. Now, I know that they have these different, you know, it's called fintech, right? All of all that is just dressing up, putting a different shade of lipstick on a pig, right? Um, giving them a new fashion. But banking is done the same way as it always um, has been done, right? Since antiquity and the gold miners' days, the gold miner era, right? The bank purchased your security. The bank purchased your negotiable instrument, right? The bank purchased your note, draft, bill of exchange, or bank acceptances, right? So even with the digital currency, it doesn't matter because your purchasing power is what gives it value. Because and when we talk about property, we got to understand that property is not the thing, it is the right of control or ownership of the thing. So when they say you transfer your property or you sell your property, you don't sell the thing, right? You transfer your rights of ownership, right? So when the bank purchase, you transfer your rights of ownership, but you gain a right of action against the bank, which is the deposit, right? That they owe you money. So what has value in this economy is not the thing, it is your right to control the thing, right? That is the definition of property. And you read that in The Theory of Credit by Henry Dunning McLeod, right? And that's very important, the definition of property. Very important. So, so we understand that a promissory note means an instrument that evidence a promise to pay a monetary obligation that the bank has received a sum of money or funds for deposit. Well, actually, we can't even say that because the deposit is their liability. So we could just say that the bank received a sum of money or funds, right? Now, once the bank receives a sum of money or funds, their assets increases, their cash under their asset side of the balance sheet increases. And the reason why we talk about the balance sheet and these cash flow statements um, and the other financial instruments so much is because banking is primarily accounting. If you want to prove anything when it comes to banking, you have to you have to talk about accounting, right? You have to analyze the accounting of the bank, right? The laws are secondary. They're there, right? I would say that the laws are secondary. A lot of it is confusing, but if you want to control your or control what you're bringing out as far as saying that the bank owes you this, you have to talk about accounting, right? The accounting of the bank, the accounting of the transactions that's under controversy, right? And based on the accounting, the bank owes you this, right? Based off of double entry bookkeeping, which is a law that the bank has to follow, the bank owes you this, right? As it always been done since antiquity. The bank purchased the instrument, their cash increase, and then they have a debt that they have to pay the general creditor, right? So, so the bank receives a sum of money or funds, right? So let's let's see if we can let's see if we, yes, this is what we need. Okay, so so the bank receives a sum of money or funds when you make the payment. Now this is 3-104. This is where it talks about negotiable instruments. And as I've said, these codes, the state of Maryland Uniform Commercial Code, or it's also referred to as the commercial law, is comparable to your state's Uniform Commercial Code or commercial law, right? As far as the location of these different sections, generally, right? It may be off some of them, but generally they have the same number, and you can just reference that number or section in your state code. Okay, so here we have a definition of, so let's take a look at the definition of instrument. So here we have a definition of a negotiable instrument, which means an unconditional promise or order to pay a fixed amount of money. So when it says promise to pay, that is a promissory note. When it says an order, that is a draft, right? But you know, if you read this, it also tells you that if the holder doesn't know if it's a draft or a promissory note, the holder can treat it as either draft or promissory note. So that just goes to tell you that these instruments are basically the same. They're all promises to pay, right? Fundamentally. Um, or even a check is an instrument. And here it'll tell you that an instrument means a negotiable instrument. So, and that relates back to the definition where it says a promissory note is an instrument, right? And it'll tell you, right? Um, this here says an instrument is a note. So here it is. It says an instrument is a note if it is a promise, right? A promise to pay. is a draft, it is if it's an order to pay. So remember, um, the definition of a promissory note, it said it's not an order. It doesn't include the language of an order. Of course, it wouldn't include the language of an order because it's not a draft, right? That's just extra language to confuse you. Okay, so let's erase this, get out of there, and then let's go to the definition of a certificate of deposit. So here we have certificate of deposit. Now let's look at this definition. This definition is more concise, right? Because the bank is not admitting that they're getting a sum of money or funds, so they don't need to confuse the definition or put confusing language in the definition. So, but if you put the definition of a promissory note at 9-102 of the Uniform Commercial Law, right, your state law, and parallel with certificate of deposit from 3-104, right, of the commercial law in your state, you'll see that they are two sides of the same coin, right? They're explaining the transaction of when a bank makes a purchase of your instrument, right? Without doubt or contradiction, that's what it's doing. And it also shows you that the bank gets value. So you are the lender because you're giving the bank a sum of money or funds when they do the data entry and put um, the value of the goods in their electronic spreadsheet and transfer the right of ownership or control of that note to them, right? And this is why when banks allegedly make deposits, they can intermingle that money with the rest of their money and they don't have to segregate it, right? Um, like a special deposit, right? So that money becomes their money, but in turn, on the it's a reciprocal performance that the bank has to do. They create a right of action against themselves. They create a liability against themselves because then they have to pay the seller or the general creditor on the liability side of the balance sheet their sum of money or funds, right? And this is going to explain that side. The first side of the definition of a promissory note explains when the bank purchases the note, what happens, what they get, right? They get a sum of money or funds when they purchase the note. Now, this is the definition of certificate of deposit is going to explain um, the other side, the liability side, what happens on the liability side where you're the general creditor and the bank is the debtor, versus on the asset side, the bank is the creditor and you're the debtor because you're promising to pay them a sum of money or funds. Right. So let's read the definition of certificate of deposit. Certificate of deposit means an instrument containing an acknowledgement by a bank that a sum of money has been received by the bank and a now this is Now they're talking about a deposit here, right? It says a sum of money has been received by the bank and a promise by the bank to repay the sum of money, right? What the certificate of deposit, that definition, and the definition of a promissory note um, explained is the contractual performance of an exchange, right? Which creates the value, right? And and I've shown you in the previous videos where the Federal Reserve says that credit is created by contract, right? Um, I would agree with that somewhat on one level, but ultimately, you're the one with the autonomous right to create credit, right? Um, Based off of your labor and your other economic quantities that you possess, right? Because you're the only one that has intrinsic value in the transaction, right? All human beings have intrinsic value, right? Generally. So let's read this definition again. Certificate of deposit means an instrument containing an acknowledgement by a bank that a sum of money has been received by the bank and a promise by the bank to repay the sum of money. A certificate of deposit is a note. It is a promissory note. It just tells you it is a promissory note of the bank, right? So you give them a promissory note, and then they give you a promissory note that evidence that they owe you a sum of money or funds. But that promissory note is cash, right? Because it is legal tender, right? And I explained the laws. I quoted the laws that explain that it's legal tender, but we'll get into them in one of these videos before I end this video series. So the bank gives you a certificate of deposit, a receipt, no different than in generally it's no different than when you give them five or they purchase $500 worth of promissory notes, which we know as Federal Reserve notes, right? Once they accept it, then they give you um, a receipt, a bank receipt, and that bank receipt is a note, right? And you could take that note and make a deposit in another bank, right? You have to endorse it, right? So I've proven that the bank gets a sum of money or funds based off off of these two definitions and the Federal Reserve document that we've read, and also, well, a couple of Federal Reserve documents that we've read in previous videos. So I believe that I've established that already that college students fund their own loan when they give the bank or their school that master promissory note. Now, we need to be able to give the school instructions that or let them know up front, and they may not want to do it, right? Because everybody's under the impression that that note is not worth anything, and that's how we've been programmed to believe. But the law says different, right? We've been miseducated in so many different things on so many different topics. um, History, mathematics, when I did 1 times 1 equals 2, which I believe is correct. Um, and, it was Terrence Howard brought that out. So I have to give him credit, right? So I did my own breakdown of it, which included some of his breakdown. But I put my own twist on it. But yeah, we've been so miseducated that we're basically paying for stuff two or three times, right? And hmm, some what we're trading is our labor for the bank inputting. We're trading our labor for, while the bank is trading bookkeeping entries. That is that is not a fair exchange. That is an unlawful enrichment. So, with the certificate of deposit, it is proof that the bank received a sum of money or funds. Now, because we've been just handing them money and not realizing it, people may not be educated enough to understand that your note that you're giving them has value. You have to demand it, right? Or you don't do business with them because it makes no sense to me if the law says that it has value. Why? And you're giving them value and consideration because a banker and a bank are not money lenders. They don't have a pile of money sitting around that they're going to loan you. When they say that your account has this amount of money in it, what they're saying is the accounting in our electronic spreadsheets says that this is the number that's in it. You have $33, or you have $580, or you have $10,000, $10 million. Those are bookkeeping entries. So, and you're trading bookkeeping entries for your labor. If you don't get a certificate of deposit, you could also do the route where you use the note as collateral, and it's in law that you can actually use the note as collateral. But why do that when you can just pay for everything all at once? Once you sign that note, you should be able to turn that note into um, a discharge of the obligation or payment to discharge the obligation, right? So I'm not telling anybody to do anything. Um, we're just getting off the ground with this organization. So we're basically just giving the public information and food for thought and things that they need to look into and research. But it's pretty simple, right? The bank purchased your note, so they owe you money as a deposit. To make it simple, you can look at the same transaction that happened when you give the bank $500 Federal Reserve notes, right? Which is a promise, which are promissory notes. They purchase it, then they owe you a deposit. And that deposit is what you come back and say, okay, I got $500 in my account. Really, there's no account, there's only accounting, but we've been programmed to believe that like it's like we're on autopilot. We don't even think about it. We've been programmed to believe that there's something physical that the bank is holding for us. There's nothing physical that the bank is holding for us. They're just the accountants doing accounting. There is no account. That is a misnomer. There is only accounting. The accountant is the account. or the accountant is the misnomer for the accounting, right? That happens in the electronic spreadsheets. The electronic spreadsheets are not credit, they're just accounting. They're records of your promise to pay, right? Which the federal um, FASB, right? Uh, FASB say that your promise to pay, from the perspective of it actually being paid, or the actual payment, because it's still a promise, right? That actual payment, as far as the chances of that happening, right? When you totally get rid of the obligation, right? When you have satisfaction in a sense, right? It is it is probable, it is remotely probable, or it is remote that that debt is going to be paid off, because your promise to pay is a debt, right? And we're using debt as money. And the only thing that you can do with a debt is keep creating other debt. So you cannot really pay off anything, right? Discharge the obligation is probably the better term. But if we're going to truly pay for it, it would have to be done in the future, because it's a promise to pay. And everything, the actual, the real payment is pushed into the future, right? And according to the Federal Accounting Standards Board, FASB, the chances of us making a real payment and totally getting rid of the debt, you know, like we would if, when we were on the gold standard and we was actually uh, had quote unquote money, but even then, what we really had was credit, right? Underneath, we've always had credit, right? We've always had exchange that creates value, right? But anyway, so they're saying that we're not going to be able to, well, they're saying the chances of it being actually paid off is remote, no, probable, right? Because we're talking about the future. Probable, remotely probable, and remote, which means that probably ain't going to happen. But, you know, I see it as once we make that exchange, that is payment, because the individual either gets some type of satisfaction, or they have the ability to make another exchange and gain satisfaction, right? But anyway, so yes, we know that certificate of deposit, we should get that, let the bank know that we need that as proof that we gave them our note, right? Which is what they use to increase their asset side. And we need to classify, let them know that you're not a money lender, right? You don't have a pile of money waiting around to lend anybody, right? Because you are the accountant. And let's say that we use the term bank credit, right? The bank credit is basically the accounting in the electronic spreadsheets. That's what bank credit is. That is another misnomer that have us thinking that the bank is actually creating credit, right? This is why I say when Richard Werner and other economists say that bank create credit, or banking professionals say that bank create credit, that is untrue. That is not true. The bank records the value and consideration that you give them, right? They purchase your security, They don't create the credit. It's already created because you're giving them legal tender and they're recording it in their electronic spreadsheets, right? And their responsibility is to do the accounting. So they're going to have record of your purchases. That is not evidence that you owe them money. That is evidence that they are obeying the law because by law they have to record or to keep track, keep a record of your purchases, right? They are essentially accountants and they use electronic accounting software that they call bank credit. So if you purchase something, those electronic spreadsheets are constantly updated and they're decentralized. So they're updated, but they, as far as my understanding, I could be wrong, they come together because they are, although they're decentralized, they're still integrated, right? And which I believe they call a blockchain, which is what they refer to as fintech, right? But they're not creating any credit. You create the credit, you create the money, you create the purchasing power, right? Because you're the consumer, you're buying and making exchanges, right? So you have the power in this consumer economy, not the bank. You just have to understand what your power is. And when economists, although I've gotten a lot of good information from Richard Werner, I believe that Richard Warner and the other economists, they're giving you a little bit of information, but they're steering you down a long, dark alley where the bank can just shoot a needle in your head and put you to sleep, right? Numb you, right? Because to say that bank create credit is stealing your power, making you the borrower, having us believe that the bank creates credit, which they don't. They call the recording of the value of the instrument that they purchased from you, they call that bank credit, which is just accounting that they're doing data entry in the electronic spreadsheets, right? The bank accounting software, which is same as QuickBooks, but of course it's more sophisticated because it has more security and you know it's connected to all these different other technology, right? It's connected to fintech and things like that. But I mean, it's an electronic spreadsheet. You know, it's a pig with a. They're putting a different dress and a different shade of lipstick and um, different type of makeup on the pig, but it's still a pig. And banking is done the same way as it's always been done, right? And money has always been credit, right? Whether you say it's, some may say it's the bank's debt is money, but it is your credit that's creating all of that because you give the bank an initial extension of credit. And we read in the Federal Reserve document, the Federal Reserve System, its functions and purposes, or its purposes and functions, one of them. But we read in that document that lending, extension of credit, and a loan is when the bank purchase your investment, which is your security, right? Investment is a note, draft, bond, bills of exchange, etc. And we've read that in the Federal Reserve document, right? So I think that we need to move into a new era where we are actually owning our power and not letting the bank dictate to us because we're making contracts with the bank. So I think that we should exercise our power to either take it or leave it. And if they don't want to give us an acknowledgement that we've given them value and consideration, we've given them credit, or we've extended credit to them, right? And the loan by with a loan, which is a purchase, they're purchasing our property, right? They're purchasing the right and control over that note. They're not actually purchasing the note itself per se. They're purchasing the control and ownership of it, which is a right, right? And then they give us a right of action, which in law is a deposit, right? That we have a right to. The right of action is that the bank has a duty to pay the debt, which is the deposit. Okay, so I think that we've exhausted the definition of a promissory note and the definition of certificate of deposit, showing that it basically explains the process. The promissory note, the definition explains the process when the bank purchases the note, because banks are not deposit taking institutions. They don't um, they're not deposit taking institutions. They don't loan money. They're not money lenders. They purchase securities that we sell to them on credit, right? And that credit they record in their accounting, right? Which becomes part of their assets. But then the reciprocal side is the certificate of deposit, which explains that the bank, under the liability side of their balance sheet, owes us a deposit, which is the bank's debt that it owes the general creditor, right? It owes us a sum of money or funds, right? The exchange is we give them a promise to pay, right, which is a note, right, which is also defined in law as a security, right? Then they give us a note, which is a promise to pay, which is also a security, right? Saying that that is evidence that they received a sum of money or funds from us. That is evidence that they purchased the note. That is evidence that um, they owe a debt. You have a right of action against the bank. The bank created a liability for themselves, right? When they purchase your note, when you extended credit to them, right? So I believe that we've definitely accomplished our goals so far, but we got more information for you, right? So I'm gonna end this video, and I know in this video I should have played Richard Warner, but you know I got carried away. But I think that I've been repetitive enough, and I wanted to do it that way. So the more you hear and see, the more you comprehend and retain information. So I think that I've beaten a dead horse as far as the promissory note and a certificate of deposit, right? So let's move on, and we're going to do that in the next video. All right, so stay tuned. See you in the next video.